up, y'all? This is your girl, Saying Van with Black Wall Street. Welcome back. Today's topic is let's talk about options. I get a lot of questions in my inbox or directly through text messages asking me different questions about options. So I wanted to come to you guys today and just answer some of those questions and see if I can clear up some of the concepts and investing tips on options, okay? So one of the questions or one of the things I like to tell everybody up front is that trading options is risky. So I've been asked a million times, is it risky to trade options? The answer is yes, okay? You're buying a contract with an expiration date. So that means there has to be movement or some activity by that expiration date that's going to be in the favor of that option that you bought in order for it to be profitable for you. If the movement is in reverse, if you're buying a call and the stock price goes down, you'll lose money. If you're buying a call and the stock price a put and the stock price goes up, possibly you're going to lose money. So yes, options are risky, okay? Next question I get a lot is, can I lose money trading options? The answer is yes. You can lose money trading options. Okay, I just explained there's a risk to it. But the good thing to know about options is the most amount that you can lose when you're trading calls and puts, and that's what I mostly concentrate on, buying calls and buying puts, is the amount that you initially invested. So if I buy a contract, an option contract, so I buy a call on an option, and I see that this call, I buy 5 contracts, and the contracts cost me $10 each. So that's $50. If that option does not do what I want it to do, I will lose $50 if I held it to expiration and the value was down. So you can lose money. Another question I'm asked a lot is, do I have to keep the contract to expiration date? The answer is no. Once you buy an option contract, you can sell it anytime you want to. You can actually exercise the option contract and buy the underlying stock at any point in that contract as well. Only thing you want to watch out for if you're going to sell options is the day trading minimum. So if you buy an option contract and you decide to sell the same day and you don't have an account with a value of $25,000 or more, you may reach a day trading, your day trading requirement or your limit, which is 3 day trades per 5 business day or market day period, okay? So prime example, today I bought a contract. Immediately, I saw that the contract was losing value and I wanted to change my position. I sold that contract, took like a $10 loss. I did it again to another contract, got out of it immediately, took like a $10 loss. The next contract I bought, and then I went up $502 gain. I sold that also. So today I maxed out in that account my 3 day trade minimum. So now I am not allowed to make another day trade for 5 market business days. And since Monday is a holiday, market is closed, that means I will not be able to make that until probably next Friday, okay? So you got to make sure you pay attention to day trading. You don't want to hit that requirement and get locked out of your account for possibly 90 days. Another question I get asked a lot is, how do I find option contracts to buy? Now, when buying option contract, there's a lot of different things you want to look for. But when I buy option contracts, the things I look for the most is contracts that have high IV, which is implied volatility, high open interest, meaning there's a lot of people that's interested in buying that contract. The reason you want to see the open interest is because you want to make sure if you went to sell that contract, there's somebody wanting to buy that contract back from you. And also a contract that has a lot of volume. I like to look at contracts that has 5 million, 10 million, 100 million, 300 million, 500 million pieces of volume per day. That means that those contracts are moving. That means the price of that stock is going to continue to fluctuate. That's where the volatility come in. High implied volatility means that stock is going to move Up or down, we don't know, but we know there's going to be a lot of volatility in that stock. Hopefully, if you have a call, hopefully the volatility is moving up. If you have a put, you want the volatility or the stock price to go down. Okay, again, what volatility, implied volatility, you have no idea which direction that stock is going to go. You just have to hope it goes the way that's going to suit your contract. Okay, another question that I am asked a lot is, what do I do if I think the stock price is going to go down? Okay, that is when you're going to buy a put on that particular stock. So let's just say GE, random stock I'm just calling out. If you know or you think GE is going to go down in the next day, 2, 3, or whatever, you may want to buy a put on GE. Because if the stock price goes down on GE, you will more than likely make money on it, okay? Then you can sell it for that profit. Another question people always ask is, what do I do? What do I do if I think the price of the stock is going to go up? If you believe the price of the stock will increase, that's when you buy a call. A call means the price of the stock goes up, you profit from it, okay? So the difference between a call and put is which way do you think that stock, that underlying stock is going to move? Call means you're bullish on that stock, thinking it's going to rise in value. A put means you're bearish on that stock, thinking it's going to go down in value. So whichever way you think the movement of the stock is going to go, that's how you want to buy your stock to make your money. Another question I'm asked is, what do I do if the contract goes down in value? Now, if the contract goes down in value, you have a couple options. But first, you want to definitely check your expiration date. If the expiration date is near, you might want to make a decision immediately. If the expiration date is far, then you can say, well, I got time on my side. If you have time on your side, then you can decide whether you want to go ahead and take a loss now, or if you want to give the stock some time to actually make a move, maybe move in a direction you want it to go. Now, me personally, and this is just a strategy I use, I like to buy my option contracts 45 days or more out, okay, for the contract. Now, I like to make a decision on my contracts when I get to that 21-day mark. So if I've been in that contract for 45 days, and by the time I get to 21 days, if I haven't already sold that contract, or if that contract is red or in the negative, I'm making a decision. Either I am getting ready to get out of that contract now, or I'm going to look at the charts again, see what I see. If there's a chance of this stock going up, I might hold on to it for a little while longer. But I know there's a chance that I'm going to have a loss in this contract. And my question to myself is, do I want to go ahead and cut the cord now, or do I want to hold on to it a little bit longer, hoping that that stock goes up? I've done it both ways. I've held and it's been great. I've made money. I've come out of the hole and it's been a profitable contract. And then I've held too long and lost even more money. So that's something you have to make a decision on, when to cut that cord. Now, I tell people this all the time. Sometimes you just have to cut the cord, take the loss, get whatever money's left in that contract, and use it for something else. Because if you still have money in an options contract, just because your contract is red, don't mean you have to keep it to expiration, okay? Remember, if you have a contract that is in the red, meaning you're losing money, you don't have to keep it to expiration. There's a chance that you still have value in that contract because it hasn't gone all the way to zero. If you sell that contract, whatever money that is yours or your initial premium that's still in that contract of value, it comes back to you to use. So that's why it's important to cut the cord, because you still have value and you can make a play with whatever money's left over. All right. Another question I get is, what do I do if the contract goes up in value? Again, this is totally up to you, how you run or sell, do what you do with your contracts. Nobody can tell you when to sell or when to hold or what to do. You have to get a stomach for this. You have to know your risk tolerance. You have to know if you have the capacity to hold long term. You have to know this about yourself. Me, I know I am a very risky person. I jump in and out of contracts all day. I lose money, I make money. As long as I make more than I lose, I am a happy camper at the end of the day. Now, so if your contract is up, what you want to do, you either want to hold that contract and see if it's going to go up more and see if you can make more gains, or you want to sell that contract and you want to capture the gains that's in it. Remember, any money that's in the market that you have in contracts, in stocks, in bonds, anything, those are unrealized gains and losses until you exit those transactions, those objects. So until you exit your options contract, those gains are not yours. They are paper gains. If you want to make them real gains, that means you have to take them out of the market. Okay. So one of the things I also want to tell you on this, if you decide to hold that contract, because these are options, we don't get to trade pre-market. We can't trade in pre-market or after-market like if we had a regular stock. So as that price of that stock fluctuates after-market or pre-market before the market opens, that volatility is going to hit your options contract first thing in the morning when the stock market opens. So there is a chance that if you went overnight with $3,000 worth of gains, the next day that could be a sell-off of those stocks pre-market, and when that contract opens up, you may have $1,000 worth of gains, or it can dip even lower. So you have to make a decision on how you feel about carrying an option contract that has value to it overnight or over the weekend or how many days. So you really have to set your strategy on how you want to take your gains, what level you want to take your gains at, how long to hold a contract. You really have to set a strategy when trading options. Okay. Another question I get is, how much should I start with? Now, if you're asking how much you should start with, I really can't tell you that. I don't know your financial situation. I don't know your budget. I don't know anything about your money. So I can't tell you how much to start with. Start with what's comfortable for you. You can start with, like I just showed somebody the other day, you can start with $50 if you want. You can find options contract that costs $10, $15 a contract. It just depends on what you're trying to invest in. Now, I do want to tell you, don't put money or start with money that you can't afford to lose, because if that option contract reverses opposite of what you wanted to do and you don't get out fast enough, that money could be gone. So you got to only invest with money that you can stand to lose, and hopefully you'll make money and grow it from there. Again, options are very risky. I get asked, what platform can I trade options on? All of the major platforms have options trading. Robinhood, Webull, Thinkorswim, TD Ameritrade, E-Trade. There's a ton of them. Doe, all of them have options trading. The thing about it is most of you may not see the options trading button or the option to trade options on your platform because you haven't enabled it. In Robinhood, you have to go in and enable options trading, okay? Enable the options trading through your settings under the investing tab. Now, if you go through Webull, you can do it when you first set up your account. If not, you have to go on your settings and enable options trading. E-Trade, same thing. They're going to ask you about options trading. If you don't set it up when you first open your account, you have to go back through your settings and you have to request to be approved for options trading. Thinkorswim is the same way. So options trading is there. You just have to go and enable it. If you don't know where to find it, or if you're having trouble, inbox me, leave a message here and I can try and walk you through it. But it is there. You just have to make sure you have it enabled. Let me see what else. Okay, so options trading is a good way to reduce your risk as well. So I did want to state that because a lot of people like to trade individual stocks, which is great. I do stock trading, but I normally do a buy and hold on my stocks. I use my stocks for long-term investments. I don't normally buy stocks to actually sell right away. That's what I do with options. Whenever I'm buying individual stocks, I buy them to hold them, to keep them in one of my retirement accounts, or in my brokerage account that I just wanted to sit and grow, because I'm buying stocks that have growth ability, and I'm buying stocks that pay dividends. Dividend paying stocks are very important, because if you reinvest those dividends, it's a way to make sure your portfolio keeps growing. Okay. Now, another thing about buying stocks, I see a lot of people, especially with this new, I forget what they call it, where you can buy shares of stocks, like portions of a company of a full stock without buying the full stock if you don't have the money. I personally haven't done that yet. It's just not a strategy that I use. I believe in buying blocks of stocks. So if I'm buying a stock, I'm going to buy a minimum of 100 shares to 1,000 shares of a stock. So it depends on the value of the stock to how much I buy. If it's $1 stock or a $2 stock, I'm probably going to buy about 1,000, somewhere between 500 and 1,000 shares of that stock. If you're buying stocks and you're buying low value stocks and you're buying those stocks that, not Tesla, Google, Amazon, stuff like that, that have high value. So when they move, the movement is real, like $30, $40, $60 movement in a day. 2 shares, okay, that's $120. But if you're buying stocks that's only $5, $3, $10, and they have a 20-cent movement in a day, you have 5 shares, you've made $10. $10 is money. You've made money. But I'd rather have 100 shares, okay, and make a lot more. I'd rather have 1,000 shares. If my stock went up $10 and I had 5 shares, I've made $50. If I had 100 shares of that same stock, how much I made? And if I had 1,000 shares of that same stock, I just made $5,000. I can buy a $1 or $2 stock, buy 1,000 shares of it, and let it go up to $4 or $5, and I just made out. And sometimes it don't take long for that to happen. So when you're buying those small shares of stock, only $2, $3, $4, $5, you're making money if they go up. But you'll make a lot more money if you owned a lot more of those stocks. So just keep that in mind when you're buying shares of individual stocks, okay? It's good just to buy stocks. You know, I want everyone to build their portfolio. But what you want to do is make sure you're building a strong portfolio of stocks, okay? The next thing I wanted to say is when you're trading on YOLO, which is you only live once, or the FOMO, fear of missing out, trades, they've been happening a lot lately. Please don't get caught holding the bag. That means when these things go up, you better take your money and go, because you don't know when they're going to turn. I've been holding and I've held on. Some of them I know to get rid of right away, okay? I know I'm not supposed to, but sometimes I just hope and wish and be like, I'm gonna get up in the morning and it's gonna go up just a little bit more. Oh, it's just gonna go a little bit more. I don't want to sell it yet. I want to capitalize on some of it. Or I may sell a couple of my contracts, because I buy 10, 20, 30 contracts of my options at a time. I might want to sell a couple contracts and hold on for dear life for the next day and hope, I wake up the next morning and then there's a dump pre-market and my options take the hit first thing in the morning. So I make decisions. Keep holding it, or sell and just take whatever I can out of that, since I've already made money if I sold a couple. So do not get caught holding a bag. I have people still asking me today, what do I do with this GME contract I have? Do I hold on to my AMC? I bought it at $15, $16. I bought my GMC at $300. I bought it at $200. Yeah, cut the cord. Just cut the cord and move on to something else. Probably has no value at this point. Well, obviously, but cut the cord. If you're not willing to throw a ton of money into it right now to average that stock value down to where it's affordable, or where it look like you can come out of the red, cut the cord. Okay. So do not get caught with the YOLO and the FOMO stocks and be holding that bag when everybody else have dumped their stocks. Okay. Lastly, people ask, can I make real money trading options? The answer, of course, is yes, you can. With the right strategy, you can make real money trading options. Now, the key word is strategy. You have to formulate a strategy, like knowing when to enter and exit a contract. what I was going to say, knowing when to enter and exit a contract, knowing your tolerance to risk, knowing your tolerance to volatility in the market. How much can you take? Knowing what your max loss is, what you will accept on each contract. Saying, okay, I lose 5% of my initial investment in this contract within whatever time frame, I need to get out. Or if I lose 10%, I need to go out. Setting a stop loss in your options trade to limit you from losing that money. All of these things is part of that strategy. So you have to have a strategy. Now, the key to options, although I told you the max amount you can lose in options, the max you can make in options when you're buying calls and puts is there's no ceiling. That means you can make as much as infinite. If that option contract continues to go up, more, you will keep making money until you sell it, okay? But if it goes down, the maximum you can lose is your initial investment. That's why options are a great hedge for risk, okay? It's risky because you can lose money, but it hedges versus on a stock. If a stock value go down, it can keep going down to the point if the company filed bankruptcy and the stock is just gone. And options, you can make decisions on how much you want to lose, okay? I think that's all I wanted to cover today. I hope I told you what an option was. Option contract represents 100 shares of an underlying stock, which you can profit from that by controlling a lot more shares of in the contract versus only having that one share of stock. So that's what an option contract is. I think I forgot to mention that in the beginning of the video. Now, that's about it. When trading options, I think it's all about the profits, okay? I tell everybody all the time, for me, it's all about the gains. It's all about the profits. It's all about the income. How much can I get on this contract? Going in, selling, rinse and repeat. Same process, rinse and repeat. Find a different stock, rinse and repeat. Keep doing the same thing, making money, knowing when to get out, jump out. You might take a loss sometimes. It's okay. I took $600 and something worth of change loss yesterday because I made a decision. The contracts weren't moving. I wanted to buy other stuff, sold those contracts, took out what money I had in there, went and bought some other stuff, making money. So that's how you have to do. Rinse and repeat. All right? All right, again, this is your girl, Sayin Van with Black Wall Street. If you have any questions, you can leave them in the comments, or if you're in our Facebook group, please just ask in the inbox or right there in the discussion thread. Everybody wants to learn options. All right, now don't forget to subscribe and like the video and join me on all of our channels. Have a great one.